Hello, my name is Thomas Krallo and welcome to my YouTube channel where we talk all things money, trading and finances in general. Now this is going to be lesson number 9 of my 10-day challenge, learn how to trade properly. Now if you haven't watched all the previous lessons, then I strongly recommend going back and doing that before watching this one. Now let's get right into the topic. So in the previous lesson we've discussed indicators and that they are not exactly reliable and they do not really explain the market that very well, so that they are not really suitable. Pure indicator trading is not really that suitable for long-term consecutive and consistent profits in the markets, and you cannot really rely on them to make millions of dollars over the course of many years. So here in the screen you can see an example of something that I'm using, one of the tools, extra tools that I'm using in my trading, and this is pretty much the basis and the foundation of my own trading that I've been using for the past 7 years, alongside with indicators and a bunch of other tools. But in this challenge I've decided to use the key market levels, correct key market levels, as an example of what actually explains the market and the psychology behind the market. So here you can see a simple, from the first glance, a simple resistance level. However, it is quite different from a simple resistance level. It has a very specific rules. Now, when we are day trading, there is a lot of risk, as you already know if you watched all the previous lessons, which you should. There is a lot of risk already, and to avoid unnecessary extra risk, we must work as structured. Our work must be as structured as possible, and we must be as careful as possible and as specific as possible. So therefore, when it comes to correct key market levels, there are CCLs and CSLs. A CCL is a candle that created a level, and the CSL is the candle that supported a level, or in other words, confirmed a level. So here is our CCL. So basically this ended up being the candle that created a level. This is CSL1, the one that supported the level, the first one. Then here is the second one, here is the third one, and the fourth one. And these candles, the CSLs, they must be right on point into the level. They cannot be above or beyond. These are exactly the ones that are confirming it 100%. Because these ones, for example, here are quite similar to these CSLs, but these are more like false breaks. These are more structures that you can actually trade. Now, why are these key market levels so important, and what do they explain? So there are 9 different types of key market levels, and once again I won't be able to go in too much detail on them here. If you want to learn more, then please attend my free webinar, link in the description below. I do a lot of webinars, they are free, and there will be a lot more information on this kind of stuff. So if interested, click on the link below and in the description, and register for my next free webinar. So the idea here is quite simple. There are 9 types of key market levels, and they are all created in different ways, different circumstances, and there are different approaches how to identify them correctly. And of course, the most important key market levels will be on the daily chart, and as I would not recommend going lower than 1 hour chart, because that's where, you know, all the super day traders are hanging around, like 15-minute charts, 5-minute charts. Those key market levels will be just too weak for my taste. I like to trade something that is for sure really in the price, and it's really engraved in stone, and it's something that is more reliable than others. So I'm just not taking any unnecessary risks, and I'm only using something that is 100% there. And these kinds of levels, do they always work? Of course not. I mean, they work mostly, but then just like everything else in trading, they will fail you a lot. And that's the reason why I use a lot of different tools. Indicators provide one type of data. Key market levels provide another type of data. Depth of market tool from a third party, some really nice provider of depth of market tool, which we will not be discussing in this challenge because it's gonna be just too much information. Now in this way, when I have so many different tools with different backgrounds, with different data, I'm able to cover for the negative aspects of each single tool. That's why I said when you're using just 10 different indicators, it's not going to change the fact that indicators in general are mathematic, are unreliable. And it does not matter if you use just one or or 100 of them. Have that spaghetti in your chart with a shitload of indicators on the price itself that you cannot actually see the price anymore, and then the 3 indicators below that as well. It's not going to change anything. These are just still indicators, and they're all still purely mathematical. And with the key market levels, there are also a few drawbacks to key market levels, and you must know those drawbacks. And then you will be able to cover for those drawbacks, for example, with the depth of market tool, that you'll be able to see the amount of orders that is actually at that level. So you'll know if that level is relevant at that specific point of time. And there are many, many things that go into trading. And once again, that's the reason why this is such a complicated business. But it is possible to learn it. All it takes is a little bit of time, dedication, and a power of will. So, okay, back to this level. So what is it that the level explains? This is actually the price, and as you can see here, it's at 10,952, and I believe this is DAX 30, DAX indices, so 10,952, and precisely at that level, at that price point, most traders would expect a sell-off. So they would not expect the price to climb higher. Therefore, anybody who has long trades from the bottom will be closing their these long trades around this area, around this level. And this is exactly the point of that key market level. So it explains, it gives you a trading map. So it maps out the price action, so maps out the price itself, and you know that here is a super strong, precise key market level that the price will resist it, and I cannot expect for the price to climb higher. I mean, it can still punch right through and fly into the sky, but it's less likely than it bouncing off. That's it. And trading is about risks and about possibilities, and basically down to the numbers. So what is more likely than not? And here in this situation, it's more likely than the price will bounce off of this level, like it did here, 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 this area, this area, this area, this area, and then I don't know what happened next. I don't remember. It's quite an old picture here. So yeah, basically this is explaining market physics, and this is explaining market psychology. So this would be the place where people would be selling off their long trades and actually opening the short trades. And this is actually, when you learn how to use those, you learn to identify those 9 types of key market levels, trading becomes quite easy. And on each single bounce, and well, I shall say a false break of this level, you can make money. This is here as a trader with 7 years of experience and a lot of trading knowledge, the belt of my knowledge. I can say that I can see here money. I can see this false break, this false break. These moves show me money. So I see money in these moves. And these are pretty much the things that I would have traded. Of course, for this to be a level, you need to have at least 1 CSL, and I would prefer maybe even 2 CSLs. So these small moves afterwards in the second part of this example of this chart, which is real market data, you will be able to see a bunch of opportunities to actually make money. And now indicators, how can you use them together with the key market levels? Sometimes there will be a situation which there isn't one here, but maybe this candle right here, it did not quite come to the level, so it was just a bit far off of it. And for me to trade the level, I need the price to come right to the level for me to trade the bounce model. For example, there are also different models to trade. And if I want to trade a false break, then I want the price go through the level and then back through the level to generate that impulse of people who believed in the true break, and to basically sell off their long positions and generate even more impulse of going down. Plus the traders who are going to be doing exactly the same as I am doing, and there are quite a lot of traders, successful traders, who are doing this. And the impulse is going to be even greater. So potentially the bounce can be weaker than the false break just because of the concept and the explainable and understandable physics, price and market physics. So yeah, And this is basically where I would use an indicator. So I would use it in this situation. If I see that the price hasn't come right to the level, I might, and it quickly is reversing, so I might assume that I haven't calculated my backlash correctly, so I wasn't ready to pay a premium to enter into this trade with this kind of a point difference to the level. So I would take, if it's possible, an indicator trade in the for the short position. And of course I would use different kinds of rules for indicator trading, for that indicator trade, to control that indicator trade, and I would apply a different set of rules to generally control that trade. So as you can see here, I'm showing you just the basics of this way of trading and what I'm using as my foundation for trading. It might seem quite simple, but there are many rules to follow, many things to learn, and many things to practice and get used to and master until you can actually try money trade with this stuff. Because trading in general bears risk, but when you start understanding these kinds of explanations and market physics and the reason why the price moves at all, a lot of people, if you remove this key market level and then you see this drop down, what happened? It just dropped down. But when you have this key market level and you have marked it precisely and correctly, will you be able to say that the price did not have enough power to break that level and the price moved down. So that's a simple explanation, the physics and the psychology behind the price. That's all. Almost each single move in the market is generated by somebody, and when you are able to trace that somebody, especially the bigger players, the hedge funds, maybe this could also be a limit player, a big player gathering a nice long or short position right at this price, and you're basically tracing the bigger players and making money on those small moves that they are generating. For example, these ones here, these are all opportunities to make a lot of money with quite a high leverage, but not more than 1% risk per trade from your total value of your trading deposit, of course, so nothing too crazy, but this is an opportunity to make quite a lot of money. Now, once again, there are quite a few rules that apply to this, and this is just a general overview, and there are many more tools that I'm using in combination with this, including the indicators, sometimes in extremely rare circumstances, but this is basically something that will give you a fighting chance in the markets. And if you want to learn more on my strategies and on trading in general, then once again hit the link in the description and register for my next free webinar, and also follow me on Instagram and feel free to send me a message with a trading related question. I'll be more than happy to answer all your questions to the best of my ability. And but if I'm not answering right away, please give me some time, because I have a lot of people messaging me with all kinds of things. And as always, if you enjoyed this video, if it was helpful for you, if I was able to clear up a few things for you in the way of explaining what actually works, what doesn't, what has a potential to work, then hit that like button for me to see that you actually are getting something out of these videos, so that I can make more of these videos and feel supported and motivated to make you guys even happier in the future. And hit that bell icon so that you are notified when I make a new upload, which is actually going to be tomorrow, and that is going to be lesson number 10 of this 10-day learning to trade properly challenge. All right, thank you for watching, and I'll see you in the next lesson.